$75 didn't save silver. It exposed the exact moment forced sellers ran out of oxygen and quiet physical demand stopped waiting for a better price. That's the part most people miss because they stare at the spot print and assume the whole story is emotion. It wasn't. This move was plumbing. It was margin math. It was calendar pressure. And if you understand why $75 mattered this week, you'll know what has to happen next week for silver to either rebuild the bull run or roll into a deeper liquidation that feels like total collapse, even while the underlying setup stays tight. And yes, we're going to get concrete. The levels that matter, what confirms the bounce, what invalidates it, and the one hidden signal that tends to front-run the headline by days. Here's the damage report with no romance. Silver just lived through a classic parabolic sequence. A vertical run, a violent air pocket, then a reflex bounce that tells you whether the move was pure froth or the start of a structural repricing. Coming into year-end, silver had already been one of the strongest stories in markets, and then it did the thing that breaks people, an all-time high, followed by a sudden ugly drop that felt like someone flipped a switch, followed by a stabilization that makes you wonder if you hallucinated the panic. That whiplash wasn't random. It was what happens when a crowded, leveraged trade runs into a thin liquidity calendar window, and the exchange decides it wants more collateral right now. And that's where the real pressure starts. If you're watching silver with any seriousness, you already know the surface level facts. Silver surged hard through 2025, and early in the first week of 2026, it printed an all-time high a little above the low 80s before snapping lower. By Friday, January 2nd, 2026, it was trading in the low to mid 70s. The crowd sees that and argues about bubble versus new era. But that's not the part that matters. The part that matters is why the market snapped back toward $75 after getting punched, and what that says about who is trapped on each side. Because in a market like silver, the trapped side doesn't just lose money, they become fuel. So let's talk about why $75 became the line in the sand. Not because it's a magic number, because $75 stacked multiple forces on top of each other. It's a round number, and round numbers don't matter until they suddenly matter to everyone at the same time. It's a strike magnet in options because big strikes cluster where humans cluster. It's a collateral anchor because margin models don't care about your long-term thesis. They care about how much you can lose in a day. And it's a narrative anchor because financial media needs a clean number to say above or below. When all those anchors line up, the market treats that price like a doorway. Above it, momentum strategies breathe. Below it, risk managers start reaching for the brakes. And when the market slams that doorway shut during thin liquidity, you get the kind of flush that makes strong hands look weak and weak hands disappear. But here's the twist. The flush doesn't tell you the bull run is dead. The flush tells you whether the bull run is strong enough to survive a collateral shock. That's why $75 mattered. Because if silver could reapproach it after the shock, it means the selling wasn't purely someone found new bad information. It means the selling was a forced unwind that temporarily overwhelmed the bid. And that difference changes the math. Now we're going to name the hidden detail, the underappreciated mechanism that reframes this whole story. Most people obsess over the spot print and miss what professional markets watch when things get violent. The structure around the price, the curve, the spreads, the cost of immediacy. Because the price can lie when leverage is being wrung out. The curve has a harder timeline. When a market is truly loose, when there's plenty of inventory, plenty of financing, plenty of willingness to carry, future prices tend to sit comfortably above spot because storing and financing metal costs money. But when a market gets tight, the nearby metal starts to behave like it has a convenience yield. It's worth more now than later because having it now solves a problem. That shows up as a curve that flattens and sometimes flips. And the reason that matters is simple. You can shove paper around with a mouse click, but you can't conjure deliverable metal on command. So, when spot gets hammered by margin selling, the curve and spreads are where you look to see if physical tightness is easing, or if it's quietly persisting underneath the chaos. That's the hidden detail. And if you track it, you stop getting hypnotized by the most dramatic candle on the chart. Because the next detail is what flips the whole setup. Before we get too deep into structure, we need to explain the why now, because timing is everything in these violent moves. People love to pretend markets are efficient and smooth. They're not, especially around the calendar. Late December into early January is one of the most deceptive windows in markets. Liquidity thins, books are being closed, risk is being rebalanced, and one external policy change can hit like a hammer because there aren't enough real bids sitting there to absorb it. Now add one more ingredient. Exchanges raise margin requirements. When volatility gets extreme, that's not a moral judgment, it's risk control. The exchange is basically saying, if you want to hold this levered position, you're going to post more cash because we don't want defaults if price gaps. When that happens into thin liquidity, It forces a very specific behavior. Leveraged longs have to either wire in more collateral immediately or cut positions immediately. In the real world, many cut positions, not because they changed their mind on silver, because they don't want to or can't post the extra cash right now. And when that forced cutting hits, it can cascade through the entire market structure. That's how you get an air pocket day. This is the forced selling engine, in plain language. Let's say you're long silver futures. You don't pay the full notional value. You post margin. When volatility explodes, margin requirements go up. When margin requirements go up, your leverage effectively goes down unless you add cash. If you don't add cash, you reduce the position. Now scale that across a market where a ton of participants are levered by design. Short-term traders, systematic trend followers, commodity funds, and plenty of retail accounts. The margin hike turns into a synchronized behavior. Cut risk now. And because futures are liquid, they get sold first. That selling pushes price down. The price down triggers more risk controls. Stop losses, volatility targets, margin calls. That triggers more selling. And suddenly you get the kind of drop that looks like collapse, even if the underlying physical balance didn't change in a day. That's not theory. That's how leveraged markets behave when the exchange tightens the screws. But that's not the part that matters. The part that matters is what happens after the screw tightening, because the bounce tells you who else was waiting. Now we talk about paper versus physical, because this is where silver is different from a lot of clean assets. Silver has a deep futures market and a deep paper ecosystem. That paper ecosystem can move fast, and during stress, it can move faster than physical reality. When forced sellers hit futures, the quote moves immediately. But physical buying has friction, procurement cycles, delivery windows, refining logistics, financing, and the fact that much of the world's silver supply is a byproduct of other mining decisions. So you get this tension. Paper can dump the quote, but physical demand doesn't instantly disappear just because the chart got ugly. In fact, in certain situations, physical demand becomes more urgent when the paper price falls because buyers treat the drop as an opportunity to secure inventory before it tightens again. That's why you can see a day where the price collapses, while the underlying availability doesn't suddenly become abundant. And when that happens, the paper market can rebound violently because the easiest metal to buy is the thing that got dumped, paper. The physical buying doesn't need to be huge, it just needs to be steady enough that the sell wave runs into a floor. And that's where the real pressure starts. Now we build proof, not one argument, a stack. Because the finance crowd doesn't respect single cause stories, and they shouldn't. So here are the layers you need to hold in your mind at once. First proof point, the shock catalyst wasn't a mysterious fundamental revelation. The shock was a leverage event. Margin requirements on precious metal futures were raised because volatility was extreme, and that kind of change predictably triggers profit-taking and forced reductions in levered positions. You don't need a conspiracy to explain a big down day. You need market structure. When the cost of carrying exposure jumps, weak balance sheets exit first. That creates a down move that looks like a verdict, but it's often a liquidity event. Second proof point, the calendar lined up perfectly for a violent response. The last week of December is a window where moves get exaggerated, reduced participation, year-end risk constraints, and a tendency for one-way trades to get crowded. When the crowd is leaning the same direction, small pushes become big. That's why parabolic rallies often end with a brutal shakeout around a calendar turn. It's not fate, it's flow. Third proof point, the policy backdrop shifted the narrative in the buyer base. The US finalized a 2025 critical minerals list that includes silver. That's not just a headline. It changes how institutions and industrial stakeholders frame the metal. Critical mineral language influences investment, stockpiles, incentives, and the political appetite for securing supply chains. And when a commodity gets pulled into a strategic framework, procurement behavior can change in ways that don't show up immediately in daily price candles. It's a slow burn until it suddenly isn't. But that's not the part that matters. The part that matters is that this narrative shift supports the idea that demand isn't just speculative jewelry and coins. A lot of demand is industrial, and industrial demand behaves differently. Fourth proof point, the structural supply and demand backdrop has been tight for years, according to industry surveys. Silver has run multiple consecutive years where demand exceeded supply, creating persistent deficits. In 2024, industrial demand was reported at a record level, over 680 million ounces, and the overall market still ran a sizable deficit of roughly 149 million ounces. That matters because deficits aren't just numbers. They are the reason a market becomes sensitive to any short-term disruption. When a market already lives near the edge, small changes in availability or demand timing have outsized price impact, and that's where the real pressure starts. Fifth proof point, supply is constrained in a way that casual chart watchers don't respect. Much of the world's silver production is not primary silver. It's produced as a byproduct from lead zinc mines and other base metal operations. That means you can't just turn on silver supply because silver price went up. If the base metal economics don't justify expanding production, silver supply doesn't surge on command. That's a structural feature. It creates long lead times. It creates a market where deficits can persist because the supply response is delayed and indirect. And when demand is being driven by large-scale industrial trends, power infrastructure, electrification, photovoltaics, data, and telecom growth, those demand trends don't reverse overnight. They may slow, but they don't disappear in a day. Now, with those 5 layers in place, we can finally talk about the level. Did $75 save the bull run? Here's the clean way to think about it. A bull run survives not because price never drops. It survives because the market can absorb a leverage flush without breaking the higher level structure. In a parabolic phase, the structure is fragile, so the question is not, did we go down? The question is, did we go down in a way that forces a new regime? That's what $75 represented, a regime line. Above it, the rally can recompose. Below it, you risk a deeper unwind where every bounce becomes a sell, and the market flirting around $75 tells you we're at the hinge. But to really understand the hinge, you need one more mechanism explainer. Inventories aren't one bucket. In metals, inventory data is often misunderstood because people treat all inventory as deliverable supply. It's not. There are categories. There are stocks that are in the system but not committed to delivery, and stocks that are registered or readily deliverable against contracts. In stress periods, what matters isn't how many ounces exist somewhere. What matters is how many ounces can actually be mobilized at the right place, in the right form, in the right time frame. That's why people who only cite total inventories can miss squeezes and dislocations. The deliverable float is what matters when someone needs metal now and the paper claim comes due. And if you're not watching that conceptually, deliverable versus non-deliverable, you will misread the entire market. Because if this one constraint tightens, the math changes. Now we pivot to the thing that retail almost always underestimates: how the market uses volatility to manipulate your emotions, even without anyone manipulating the market. Volatility itself is the weapon. It creates false certainty. A huge green day makes you feel late and desperate. A huge red day makes you feel stupid and panicked. Both feelings are designed by the structure of the market to push you into the worst possible decision timing. That's why this script isn't about telling you buy or sell. It's about giving you a shield, a way to separate trend signal from noise, and a way to act without being used by the whipsaw. Here's the simplest shield. Accept that price can whip around violently even if your thesis is correct. That's not a disclaimer. That's the nature of a levered commodity in a structural deficit narrative. The trend signal is the higher time frame. Higher highs, higher lows, supportive macro backdrop, and persistent demand drivers. The noise is the liquidation wave triggered by margin and thin liquidity. If you confuse noise for signal, you'll sell the bottom of a forced unwind and then watch price reclaim the level without you. If you confuse signal for noise, you'll over-leverage and get forced out, even if you were directionally right. That's the trap, and that's where the real pressure starts. So let's go deeper into macro, because the metals crowd doesn't trade silver in a vacuum. Silver lives in a triangle: real rates, currency stress, and industrial cycle. When markets price future rate cuts, the opportunity cost of holding non-yielding assets tends to look less punishing. When currency confidence gets shaky, whether from deficits, geopolitical tension, or a general risk-off regime, hard assets catch bids. And when industrial demand is strong, especially in electrification and energy transition themes, silver has a dual identity: monetary-ish and industrial. That dual identity is a blessing in rallies and a curse in panics because the narrative can flip. Bulls say it's both safe haven and industrial. Bears say it's too hot and industrial demand will slow. The market will try to make you choose one identity at the worst possible time. But that's not the part that matters. The part that matters is how those identities translate into flows, because flows move price. In 2025, precious metals broadly rallied and silver notably outperformed. A big move like that always invites 2 reactions: institutions that decide they need exposure because the regime is changing, and institutions that decide they need to reduce exposure because volatility is too high. Those forces fight. The exchange steps in with margin changes to reduce systemic risk, and the result is a market that looks chaotic but is actually behaving according to incentives. The incentives are simple. Risk managers hate gaps, funds hate drawdowns, industrial buyers hate supply uncertainty, and speculators hate missing the move. Those incentives don't cancel out. They clash. And the clash creates the kind of tape you just saw. Now, the single most important question for the next 1 to 2 weeks isn't, is silver bullish long term? The question is, does the market rebuild above the pivot, or does it fail the retest? Because if the market retests $75 from above and holds, It tells you the liquidation flushed weak hands and demand is still there. If the market can't reclaim $75 convincingly, or reclaims it briefly and then loses it with momentum, it tells you the bounce was just short covering and the market is still heavy. That's why we need to get practical. Let's translate the mechanics into a roadmap. Think of $75 as the pivot. Think of the low 70s as the danger zone, where another wave of margin stress can cascade because people anchor their risk limits there. Think of the low 80s, call it the $80 to $83 area, as the gate where you can trigger a squeeze-like continuation, because breaking back into the highs forces a brutal choice on anyone who sold the crash: chase or miss. And that choice is fuel. But it only becomes fuel if the market structure supports it, because you can't squeeze without a shortage of sellers and a reason for buyers to press. The next detail is what decides it: whether the market shows higher lows and whether the structure underneath, spreads, curve behavior, and general tightness signals, stays firm rather than loosening as price bounces. If tightness loosens rapidly, it suggests the spike was pure froth. If tightness persists, it suggests the froth got shaken out, but the underlying squeeze potential remains. And that's where the real pressure starts. Now let's confront the counterpoint head on, because it's valid. Parabolic moves can break. They can break hard. They can break in a way that makes people swear off the market for years. And in silver, the history of violent pullbacks is not theoretical. That's why credibility requires saying what could kill the thesis, not just what could confirm it. Here are the clean failure modes without drama. 1. Repeated margin hikes and risk tightening can keep pressure on leverage longs, forcing continued de-risking even if the story is intact. 2. Speculative positioning can get too crowded. If too many participants are in the trade for the same reasons and with the same risk limits, the market can trigger a domino effect by breaking one key level. 3. Macro can shift. If real yields spike or the dollar strengthens sharply, it can compress metals even if industrial demand is stable. 4. Industrial demand can slow on the margin, not collapse, but slow enough that the market doesn't need to price scarcity as aggressively. 5. Supply can respond at the margin through recycling and higher recovery from scrap, easing near-term tightness. None of these require the world to change overnight. They just require enough pressure to keep the market from rebuilding above the pivot. So if you're honest, you hold these in mind. But that's not the part that matters. The part that matters is how you use them as signals, not fears. So here's how you watch it in real time without being emotionally farmed by the tape. You watch for behavior around the pivot. Does price dip and get bought quickly, or does it bounce and get sold immediately? You watch for the character of rallies. Are they grinding and controlled, or are they spiky and then fading? You watch volatility, not because volatility tells you direction, but because volatility tells you risk regime. When volatility is high, leverage is punished. When leverage is punished, the market can overshoot both ways. That's why you don't anchor on, I was right. You anchor on process, and that's where the real pressure starts. Now, let's connect the critical mineral designation to practical market behavior, because this is one of those policy shifts that can be underpriced for longer than you expect. When a government labels a mineral critical, it signals concern about supply chain vulnerability and strategic importance. That can influence permitting priorities, investment flows, funding eligibility, and corporate procurement strategies. Even if it doesn't instantly create new mines, it can change how industrial players think about securing supply. That changes timing. Instead of buying just in time, procurement can shift towards secure and stockpile. And timing changes are everything in commodities. You can create a tight market not only by increasing total demand, but by pulling forward demand, buying earlier than usual. That can steepen stress in the nearby market, exactly the kind of stress that shows up in curve behavior and spreads. So the policy headline isn't the reason silver ticks up $1 today. It is the reason the market can stay tighter than bears expect, for longer than bears can stay comfortable. And that's not a guarantee of higher price. It's a reason the market can behave like a spring. But that's not the part that matters. The part that matters is whether the spring gets rewound after the flush. Now we return to the main question. Did $75 save the bull run from total collapse? The honest answer is $75 is the test, not the verdict. The save only becomes real if $75 transitions from panic line to support line. And support is not a number. Support is behavior. Support is buyers stepping in repeatedly and sellers failing to follow through. Support is the market telling you, we tried to break it and we couldn't. That's when collapses fail. That's when trends resume. But if $75 becomes a ceiling, if every rally into it gets sold, then the bull run hasn't collapsed forever, but it has entered a different phase, consolidation or deeper retracement. And in a parabolic market, that phase feels like betrayal, because it's not dramatic upward anymore. It's choppy, it's punishing, it's designed to make both bulls and bears feel stupid. That's why most people lose money, even when they pick the right direction. They can't survive the middle. So let's talk about how the middle is created, because this is where market structure gets sneaky. After a margin-driven flush, you often get a bounce that is partly short covering and partly opportunistic buying. Shorts cover because they made money fast and they don't want to overstay. Opportunistic buyers step in because they wanted exposure but didn't want to buy the top. That bounce can be sharp. Then you usually get the real test. Does new buying appear on the first pullback, or does price drift because everyone is waiting? If new buying appears quickly, it suggests genuine demand. If price drifts and liquidity is thin, it suggests the bounce was mostly mechanical and the market is still digesting. Neither is good or bad by itself. But it tells you what kind of tape you're in, trend resumption or repair, and that's where the real pressure starts. Now, we need to address something that metals investors talk about endlessly, often badly: paper suppression. Here's the finance literate way to hold that idea without turning it into cartoon certainty. Markets are not moral, they are incentive machines. Big participants have incentives: hedging, inventory management, financing, and risk control. Those incentives can create patterns that look like suppression or protection depending on where you stand. But you don't need to claim illegal behavior to respect that structure can lean on price. The practical takeaway is not, they control it forever. The practical takeaway is, price can be pushed around in the short run, especially during thin liquidity and leverage events. And if you know that, you stop treating every drop as a referendum on the story. You treat it as a test of who gets forced. Because forced participants move markets. And the moment forced selling exhausts, the rebound can be violent. That's why silver's tape feels like a trap. It is a trap, if you let it be. Now we're going to get specific about what to watch next week, because this is where trust is built. Not by hype, by a checklist that holds up whether the market rips or dumps. First, watch whether the market can reclaim and hold the $75 pivot on closes, not just intraday spikes. Intraday moves lie more than closes when volatility is high. Second, watch the reaction to the low 70s zone. If price dips into the low 70s and springs back quickly, it suggests demand is defending. If it slices through and struggles to bounce, it suggests the liquidation isn't finished. Third, watch the relationship between rallies and volume participation. You don't need a data terminal to feel it. Strong rallies tend to be persistent. Weak rallies tend to pop and fade. Fourth, watch the high 70s into $80 area as the squeeze gate. If price approaches it and stalls hard, it can create a second pullback. If price breaks into it with speed, it can force a chase because anyone who sold the crash will feel that old emotion, regret. And regret creates bad decisions. Bad decisions create fuel. Fifth, watch volatility itself. If volatility compresses while price holds the pivot, that's often constructive because it means the market is stabilizing and leverage can re-enter more safely. If volatility stays extreme and margin remains tight, expect whipsaws. And that's where the real pressure starts. Now let's place this into two scenarios because this is how you stay sane. One base case, one squeeze case. Neither is guaranteed, both are plausible. And the point isn't to predict perfectly, the point is to know what would confirm each so you don't get emotionally kidnapped. Scenario one is the controlled pullback and retest. In this scenario, the market continues to stabilize around the mid-70s, dips into the low to mid-70s, and buyers defend the pivot region. Price action becomes choppy but constructive. Higher lows, smaller ranges over time. Volatility cools, the market gradually rebuilds confidence. Then, over the next week or two, silver starts pressing back toward the high 70s and tests $80 again. In this scenario, the bull run isn't saved by one day. It's saved by a sequence. Hold, retest, rebuild, then attack. Confirmation looks like repeated defenses of the pivot and less violent selling on down days. Weakening looks like failure to reclaim the pivot after rallies and progressively lower bounce highs. Scenario 2 is the continuation squeeze with gap risk. In this scenario, the bounce doesn't just stabilize, it accelerates. The market quickly reclaims $75, then pushes into the high 70s, and the moment it threatens the prior highs, the psychology flips. Shorts get nervous. Sellers who took profits after the crash realize they might not get a clean re-entry. Momentum funds re-engage. Headlines turn bullish again. And because silver has a history of moving fast when it gets moving, you can get gaps, moves that happen when you're not prepared. That's why this scenario has more upside potential, but also more risk. Confirmation looks like strong closes above the pivot and a rapid march toward the highs with minimal giveback. Invalidation looks like a failed breakout attempt that reverses hard, because in parabolic markets, failed breakouts can be brutal. And that's where the real pressure starts. Whichever scenario plays out, the discipline stays the same. Treat violent drops as possible leverage events until proven otherwise, and treat sharp bounces as possible mechanical moves until proven otherwise. Then use behavior around key levels to decide which is turning into the dominant regime. The biggest mistake in markets like this is thinking you need one perfect call. You don't. You need a process that keeps you alive through volatility and present for the high probability moments. And one last thing, because this is the part that separates serious viewers from dopamine traders, the market will try to use your identity against you. If you're a silver bull, it will embarrass you with a crash that makes your conviction look naive. If you're a skeptic, it will embarrass you with a rebound that makes your caution look like paralysis. The winning move is refusing to let the market define you. You're not a bull or a bear. You're a tracker of signals. You watch structure, you watch incentives, you watch the calendar, and you respect risk. Because the truth is, silver can rip higher and still punish you if you're over-levered. And it can dip hard and still be in a bull market if the underlying setup remains tight. The game is not be right. The game is don't be forced. Because the forced participant is always paying someone else. So here's the final takeaway that ties the whole story together. $75 didn't magically rescue silver. It became the arena where three forces collided. Exchange-driven leverage unwinds, strategic and industrial demand that doesn't disappear on command, and a calendar window that exaggerates every move. If $75 holds and turns into support, the bull run didn't collapse. It simply shed weak balance sheets and set the stage for the next leg. If $75 fails and becomes resistance, the bull run isn't over, but the market is telling you it needs more time to digest and more weak hands to flush before it can run again. Either way, the smart play is the same. Stop staring at the loudest candle and start watching the signals that move first: structure, behavior, and the incentives that force participants to act. And if you're the kind of investor who wants to build wealth in markets without being farmed by headlines, this is your edge. You don't join the crowd when it feels safe. You don't panic when it feels scary. You track the hinge points and you let the market prove itself. If you want, drop a comment with the one level you're watching, $75, the low 70s, or the $80 gate, so we can compare notes like a real desk, not a comment section.